It's been a long day, and congratulations on making it to the end. If this was a conference in Britain, you would be half the number you are here. So I'm genuinely impressed at that. I'm going to make an argument to you in the 15, 20 minutes I've got to talk that you, we, all the people like us will be called upon on our watch to mobilize solar even faster than all the impressive statistics you've heard today. And that is because I think, and if people like me are right, it won't be organic evolutionary policy making that will decide the future of our industry and our markets. It will be mobilization under profound energy crisis. So that basically is my argument. I'll run through why I think that. But first of all, I want to talk about the financial crisis very briefly, because it's pertinent to what I'm going to say about the energy sector. In the run-up to the credit crunch of 2007 and the financial crisis of 2008, we know that a massive industry, an incumbency in the financial markets, made a catastrophic error in its assessment of its asset base. And we're talking about mortgage-backed securities and derivatives of them. You all lived through it, you all know what happened. There were a minority of people who were warning that the narrative from the industry, the happy language, the language of having excised risk from complex derivatives had a few flaws, and these people were trying to sound an alarm. And they were marginalized, they were accused of ignorance and scaremongering, even though some of them were economists, in one or two cases with Nobel Peace Prizes and forward-looking journalists. So we have this whole history for the financial crisis. And it's incredible to me sometimes that more people don't sort of look at that whole set of learnings that we should have had and ask themselves, you know, is it possible that another great industry, another big incumbency is making the same basic error of assessing its asset base? I and people like me, of course, think our industry, the wider energy industry, is in the process of making that mistake and making it on multiple fronts. So I want to talk about three sets of risks, systemic risks, that the incumbency, I'm going to call them, the traditional energy industry, are in the process of making. And they have to do with the risk that their assets will be stranded, carbon fuel asset stranded risk, that's the first one, otherwise known as the carbon bubble. It's not a real financial bubble, but we often refer to it as the carbon bubble. I'll talk about shale, gas and oil, and the possibility that there's a surprise there, that this narrative that we're spun all the time of a plentiful new supply of cheap gas and oil might be flawed. And then I'll talk about global oil supply, so conventional oil supply. These are the three things that I'm going to run you through, and then just right at the end, I'll talk about how I think it's going to play out. So I'll have to go very fast, and I'm not going to go into detail. That's one of the reasons I'm not using PowerPoint. I'm just going to try and interest you in following these dramas, because if I'm correct, these will be the big determinants of all your vocational lives. They'll play out, are playing out, I would argue, on your watch, and you'll have to deal with them. So let me start with carbon fuel asset stranding, risk. Now this ties into the climate change debate indirectly, because as you all know, most of the governments of the world are trying very hard, in most cases, to negotiate a treaty that has to be delivered in December 2015 in Paris at the annual climate summit, which that year is in Paris, that will have teeth in terms of legally binding targets and timetables for greenhouse gas emissions reductions. If they fail, then the world will stay where it is now, on the road to 6 degrees of global warming. And I'm not going to go there. but I suspect you believe me when I tell you the vast majority of scientists who study this issue tell you that if that happens, it will be an economic and ecological catastrophe for the world. So that's what they're trying to head off. Now, their targets, many of them, involve a ceiling of dangerous global warming of 2 degrees Celsius of global warming on the global average since the beginning of industrialization. 2 degrees. That would require very substantial deep cuts in greenhouse gas emissions generally, and essentially a phasing out of carbon in the energy mix by the middle part of the century. Now, right now, the capital markets and the energy industry as a whole assume that there is a very precise risk of governments delivering that, which is zero. 0 today, 0 next year, 0 10 years from now, 0 30 years from now. So that right now they're able to account their assets as though there is no risk at all of those assets being impaired. And more interestingly still, no risk at all of investors ever recognizing that there might be a risk and acting on it. So anyway, a small group of financial analysts in the City of London in 2010 got together and decided this was really a dysfunctional state of affairs, and they were going to try and draw attention to it. And they were people from the asset management industry, the investment banking industry, themselves worried about climate change. They asked me to be their chairman because of my background in the oil and gas industry, in and around the oil and gas industry, and also I've been a non-executive director of a private equity fund investing in renewables ever since 2000, so I've seen the financial crisis all the way through from the inside of a boardroom, as it were. So what this group called Carbon Tracker did was produce a first report in 2011 that for the very first time took this ceiling of danger, 2 degrees Celsius, and worked out a carbon budget and then ascribed it stock exchange by stock exchange and company by company across the energy sector. This, believe it or not, had never been done before, even though the first Intergovernmental Panel on Climate Change report went right back to 1990, the first real warning about climate change from the world's climate scientists. But this was the first time it had been set in the language of the capital markets. And for those of you who haven't seen these reports, do have a read of them. They're on the Carbon Tracker website. They have executive summaries of just a few pages. The detail is heavy, but the exec summaries are, like the IPCC, very readable for non-experts in finance. In any event, this immediately had an effect where, climate scientists and environment groups hadn't had much of an effect, arguably, in registering arguments about climate change. The first report, for example, was covered 6 times in the Financial Times. So this is a new angle in the carbon climate debate. The second report came out in 2013, and by this time I knew, as sort of chairman, it's not my idea, I'm not founder of it, I'm not even an analyst in it, but I'm watching it from the inside. I knew that this was something new, that it was going to get great traction, but I didn't fully understand how great the traction was going to be until the panel discussion after the presentation of the report, because this report looked at Capex for the first time, worked out the Capex numbers, just how much the oil, gas and coal industries were going to have to invest to keep their particular part of the energy equation going. In the case of the oil and gas industry, it's mostly, of course, invested in exploration, production and development, but also in actually maintaining the infrastructure base of the current reserves. And the thing about the carbon bubble is that when you do that arithmetic on the 2 degrees Celsius danger ceiling, what you find out is that proved reserves alone, the reserves that we know about, not the resources that they're exploring for to turn into reserves, proved reserves alone mean that anything up to 80%, certainly more than 60%, of those proved reserves cannot be burnt, have to stay in the ground if governments are going to stay below the 2 degrees Celsius. So you've got this risk being posed to the Capex going forward that, you know, investors will turn around and say, well, wait a minute. You want to spend all this money on finding more reserves, yet most governments are at some point going to try and force you to keep that reserve base under the ground unburnt. And so the figure that the team worked out for Capex expenditure based on 2012 figures was $670 billion annually of Capex deployment by these companies. Now the key thing here is what's the return on that capital, what are the chances of it being wasted on top of the climate risk, and how much is the oil and gas and coal industries giving back to the investors as dividends? And the answer to that is well under $200 billion a year. So if you like, you don't have to think of it as a climate change equation. You can think of it as a capital efficiency equation. And again, for that event where we launched that report in Bloomberg, I listened to the lead oil and gas analyst at HSBC, the investment banking part of HSBC, say to an audience of financial people from the city, I have listened to these arguments, I combine it with the lack of profitability of the oil and gas industry as they spend ever more on Capex. Their Capex has trebled since 2000 and find less and less oil, and it's more and more costly, and they're less and less profitable. You combine that with the risk of this carbon bubble overhang, and I'm going to go back to my clients of my bank, and I'm going to start telling them that they have got to stop this deployment of Capex because it might be money wasted, and they've got to give a large part of it back to us as dividends. So what is the reaction to all this if you're an investor in fossil fuels? Well, you can do two things. You can say, crikey, there is a risk, I'm going to divest. Or you can say, there is a risk, I'm going to stay invested, I'm going to put pressure on the Capex, I'm going to get these people to become more profitable by doing less in terms of Capex, but giving us back more as dividends. And both these things have started happening. Not just because of carbon trackers work, but if you've missed this, do check it out on my website and Carbon Tracker's website. Let me give you a couple of examples. First, of divestment. The institutions that have started saying, we recognize the risk of stranded assets, we recognize the risk that policymakers may do something about climate one day, you know, whether it's panic or whether it's just a critical mass of well-meaning people finally getting their act together. And therefore, you know, these are assets that could be stranded. We're not going to invest anymore. Storebrand, Norway's biggest insurer, has done that. AP4, one of Sweden's 5 state pension funds, has done that. A massive local government pension fund in Australia has done it. And city by city and campus by campus, students are beginning to, as you will know, I think, from the newspapers, students are beginning to put pressure on institutional investors to stop investing in fossil fuels. And it's beginning to pay. The University of Stanford is the most recent university to do it. And American cities have got it very much on the radar. So this is useful if you're in the renewable energy industry, because the more problems the incumbency has, the better our chances, arguably, of taking market share from them. But it's not actually going to shift the dial. It's more political than game-changing in terms of capital flows. What really is game-changing is pressure on the Capex. And again, you can see the markets beginning to move here right now. Shell, for example, this last year has had to give in to shareholder pressure and stop its exploration program in the Arctic. That's been put on ice, if you'll pardon the pun, for the year of 2014. They can't do it in 2015, 2016, 2017 and on. If they do, they no longer have a viable business model. They're essentially in contraction mode. So this is the state of the argument, and things are going wrong for them on multiple fronts on this score. The biggest Capex disaster story, if you don't know this, do have a look at it, because if it wasn't so serious, it would be funny. Kashagan, massive oil field in Kazakhstan. It was discovered in 2000. The oil industry told the world, we now have a massive supergiant field that's going to be a huge stream of profits for people way into the future. We're going to be bringing it to market in a few years. The total Capex expenditure will be about $10 billion. That was in 2000. Fast forward to 2014, the oil field, if you don't know this is all true, the oil field came into production finally 14 years later. It was producing for a few weeks. It had so many technical problems because of the acidic, deep-seated oil that was coming up and attacking the pipe work that they've now shut it down for 2 years. The Capex deployed so far is $50 billion and counting. And it may never be produced. If I had £1 for every time an oil gas industry person had said to me, forget about oil supply, global oil supply, with things like Kashagan, we're going to walk it. We'll easily be able to meet the demand. So these are the pressures on Capex, and that carbon bubble story is one to watch. I think it's going to, I safely predict to you, it's going to play out very quickly with great drama, and may even materially affect the dynamic in Paris at that vital climate summit. Now let me talk about shale. Now you all know and you hear all the time that there's a narrative of plenty in shale. And of course there has been in the States. There really has been a boom. They produced a lot very quickly, and it has driven down the gas price, and big parts of American society have benefited. But of course the narrative of plenty goes that that is going to continue. It's sustainable, and it will continue off into the 2020s and 2030s. They don't seem able not to hype what they're doing. But let's scratch below the surface a little bit, and forgive me if you know this already, but if there is a sustainable boom that can keep going for decades, how is it that all the shale plays, all the regions where shale gas has been produced, the production has peaked and is starting to drop? If you stack them up on top of each other, you can already see that the production's gone over a top, with the exception of one, the Marcellus Shale that goes up the east coast of the States, and that's what's keeping the whole production going for the moment. But there are geologists all over the data who are in the camp of the people who are blowing whistles saying, watch out, this boom is going to turn to bust, it's going to turn to bust very quickly. Are they making money, the oil and gas companies? If you're an investor, you look at these companies and you look at their profitability, and this is one to try at dinner parties and on your friends if they tell you that, you know, at the level of mantras, there's a boom going on in America, it's going to go on forever, it's going to be exportable to other countries. Are they making money? The top 15 oil and gas companies so far since the boom started in the noughties have written off, wait for it, if you don't know the number, $35 billion at the last count. They're losing money hand over fist. Their cost of drilling is way over what they're getting from the monies coming back to them from oil and gas. So the first question about shale is the whole American story of plenty going to stay on the rails? And I would argue on the balance of probabilities not. But even if it doesn't, what then? Can they export it to the rest of the world? And here you've got the questions that are pertinent to politics here in the Netherlands and in the UK. You have certain elements of society telling us that we've got to copy the Americans. My Prime Minister went to Davos in January and said, you know, I paraphrase but fairly inaccurately, we are going to do what the Americans have done. We're going to get cheap gas from fracking the country, and we are going to, no, this is, I mean, like I say, it would be funny if it wasn't so serious. And we're going to bring manufacturing industry back to Britain. That's what he told the world in Davos. Now, who's advising this man? Because, number one, to get cheap gas, you've got to bankrupt your oil and gas industry, right? The Americans are desperately praying for the gas price to go up. And number two, if you look at the aerial photographs of these sweet spots where they drill and drill successfully for shale gas and shale oil, and you look at the level of industrial infrastructure, you cannot possibly imagine that superimposed on conservative rural Britain. The government's own voters will be dying in ditches to stop that happening. This, of course, is one of the reasons it's been banned in France. The French government knows this. They also want to defend nuclear, of course. So, you know, you've got big exportability problems, and country by country, you see the story not playing out very well. In Poland, they were desperate for shale, but of course, Exxon drilled 3 wells and pulled out, low-quality shale. In China, water seems to be a big problem. This is incredibly water-intensive stuff, and so it plays on. Will there be a shale surprise? I use the word surprise to be polite. I don't think it's going to be a surprise at all, and neither do the people like me who are speaking out about this from within and around the oil and gas industry think it's going to be a surprise. But in terms of the narrative, it's certainly going to be a surprise. And let me make this point quickly about the difference between the financial crisis and the coming global energy crisis. In the financial crisis, it was only economists and financial journalists who were blowing whistles. This time, it's people with experience of the oil and gas industry, around the oil and gas industry, and practitioners still active in the oil and gas industry. That's a big difference. Still a minority view, but a very different perspective. And that brings me to my third and final risk, which is the risk of global oil supply not behaving as the incumbency tells us it's going to behave. And what they say, paraphrasing, is that oil supply has been rising for many years. It continues to rise. We'll always be able to make it rise and stay ahead of any conceivable profile of demand for decades into the future. This is what ExxonMobil will tell you. This is what BP will tell you. And they will use belittling language for those who question that, the same way that Goldman Sachs and Lehman Brothers and the others did in the run-up to the financial crisis. People who don't understand, who argue differently, don't understand, they say. They're guilty of scaremongering. The famous phrase at BP that they repeat time and time again is, "We don't believe in peak oil at BP." And you say, wait a minute, you should be saying you don't believe in the possibility of a global peak in oil production in the short term. There's certainly, you cannot not believe in peak oil because this is a finite resource, right? It has at some point to peak and can't go on forever. It's not replenishing itself under the ground. So, but this is what they say. We don't believe in peak oil, period. And I debated Tony Hayward, the former chief executive of BP, at the Financial Times Global Energy Leaders Summit in a panel where he said BP doesn't believe in peak oil and gas supplies are going to be infinite. He used the I word. This is a man with a PhD in geological science. He told the audience that gas supplies are going to be infinite. And he said that oil supplies were going to be essentially, to all intents and purposes, he said, infinite as well. And I'm making a serious point here because it's about the mythology, it's about the mindset, it's about the cultural degree of comfort in spinning a narrative, basically. In his own mind, he's not doing anything wrong, he's not telling a lie, he's just doing a bit of marketing. And the neuroscientists understand all this, and to refer back to their role in the whole business, you know, when you describe these kinds of things to people studying the human brain, they're not surprised because, you know, their 10-year body of experimentation and observation of how we think individually and collectively tells them that we are prone to predictable irrationality, they call it. They recognize something called the incumbency effect, where we attach much greater value. We tend to attach much greater value to something that we have as opposed to something that we might have that rationally would be a better thing to have. And all this kind of thing that I think explains the dilemma the energy incumbency is in and gets me to where I am, which is that I don't think it's a great conspiracy or anything like that. I just think it's a problem of human culture that we have to understand and overcome. But anyway, 3 lines of argument on oil depletion. There are many more arguments. This is a game for nerds. It's a game for sad acts like me who have 3 hours a day to study all the detail. But the first thing to look at is the Capex. I mentioned it already. Oil and gas has been tripling its capital expenditure since 2000 to the present day, and the major oil companies find less and less for that. They're going further and further into frontiers that are providing them with the kind of problems that I described at the Kashagan oil field. So Capex is the first big worry. The second big worry is the rate of descent of the conventional crude. You'll all be aware there are different species of oil, but what we really rely on is conventional crude, where production at the moment is 69 million barrels a day out of the 1991 of the global total. That's the stuff that was easy to find and easy to produce. That's the stuff the Saudis have in enormous quantities. That's the stuff you see hitting the rocks when tankers go down. So what's going to happen to that? And then here we've heard a lot about the IEA today. What does the IEA say about this? The IEA says it's going down. There's nothing you can do to stop it except spend lots of Capex in propping up the production. If you spend lots of Capex in keeping the production as high as you can through to 2035, you go down from 69 million barrels a day, wait for it, who don't know this, to 38 million barrels a day by 2035. If you don't spend that Capex, you go down to 10 million barrels a day. This is the real challenge for this industry, because all that shortfall has to come from all the other ways you get oil, the unconventional oil, the tar sands, the tight oil, all the rest of it. And this is why people like me think it's going to be absolutely impossible for them to do this. So, inevitable descent of the bedrock of global oil production. And then the third thing and the final thing for this talk, although there's lots more, as I say, in my book and on my website and in the studies of people like me who are working on this, exports, oil exports and domestic consumption of oil in producing countries. So if you don't know this, again, it may come as a surprise. The amount of oil that was exported in the world looks as though it peaked in 2005 and has been going down ever since. Easy to understand why. Just go to Saudi Arabia. Consumption domestically in Saudi Arabia has been going up at 8% a year for many years now. And this is because they're burning oil in electric power plants, like there's no tomorrow. Why aren't they burning gas? Turns out they don't have that much gas. The empty quarter is not called the empty quarter for nothing, it turns out. So they're burning all this oil, and if that domestic consumption of oil carries on at that rate, and if they keep their production up at current levels, which many of us doubt they can, you take those two lines forward into the future to when they intersect, and when do they intersect? Before 2030. Intersection would mean they don't have a drop of oil left to export anywhere in the world. Now, wouldn't that be slightly inconvenient? And that's just one country. There are other stories like it as well. To be fair to the Saudis, they know that, and this is where we come in. What is their solution to this terrible problem of wasting oil in domestic electric power plants? Is the answer going and finding, bigger fields, better fields, more fields of oil? No, that's not what they pretend when they give presentations and interviews on this. They say the solution is nuclear and solar. And that's why there's going to be a very good solar market in Saudi Arabia. They should get a move on. They've been talking about this for a while, but they certainly will have to go those two routes, and where they find the water for the nuclear, I have no idea. But the solar is a different matter. So that brings me to the conclusion, which is, I hope I'm wrong in this, And I really do hope I'm wrong, but I can't persuade myself I am or come anywhere close to it when I study all this. I think we're going to have a massive global energy crisis on our watch within a few years. Most likely it's going to be related to a wave of panic about oil supply, global oil supply, despite everything you hear from the incumbency about the narrative of plenty, okay? So if that is the case, what's the corollary? Well, obviously the news is bad. Things are going to get a lot worse before they get better. The last crisis we had, the financial crisis, there's every chance that the next one would be, you know, a good deal worse. We really will be stressed. But here again, the neuroscientists kick in and tell us encouraging things this time. We're individually and collectively much better at working with clear and present dangers. We work together well. We work faster than we think we can by pooling our resources. We surprise ourselves. Mobilizing for war is a good example of this, when the danger is clear and present. So this is what we will be called upon to do. And the neuroscientists talk about the power of context. So our leaders had the power of context in the financial crisis. Once it was clear that waves of panic were spreading through the capital markets about the toxicity of mortgage-backed securities, they acted, and arguably they headed off the worst, which easily could have been economic Armageddon. You might say they only temporarily staved it off, but anyway, we will see. And so they'll have this chance again with energy. And then we, of course, will be far readier to respond in the way of mobilization than most people would give us credit for, because of this massive negative propaganda pushback against us from the incumbency, simply because our success now has made those people see that we are an existential threat to them. We've heard today, right at the beginning, about the death spiral of the utilities. We and wind essentially have done that to the utility business model. And if you read the latest analyst report from Bernstein about what's coming next, if you don't know this term, it's wonderful. They talk about the terror dome, which is our cost-down profile, and where it intersects with the pricing of oil and gas. And they say, look, this industry, solar PV, has done that to the utility business model at well under 1% of the global primary energy mix. When they get up to quite a bit more than 1%, an order of magnitude more, they are going to be doing the same thing to the oil and gas industry with all the other technologies that we'll be acting in strategic harness with. So my message is not totally gloomy, and the book that I've written about this is called The Energy of Nations, Risk Blindness, which is what I've been talking about, and The Road to Renaissance, which is the flip side, the upside message. I'm not able to talk to you with total conviction that we can get to the road to Renaissance. It's very easy to erect a narrative that involves a road to ruin out of everything I've told you. But I do, with hope in my heart, say to you honestly that I think there is a chance from all this mess that we can get to a road to Renaissance, and I know that all of you will have major roles to play in that drama as it plays out, if I'm right. Thank you for listening to me.
Yeah.